How you doing, friends? It is. I gotta pull up here. This is the final hour show from 0 days to expiration. And it is Monday, July 31st. Today, we're going to talk about entries. How to enter a 0 DTE position the way we do it. I guess I could discuss also the way other people are entering trades, but I'm not going to. It's a futile. And maybe that sounds a little arrogant. I don't know. But we are here to show you how it's done. How I know that professionals do it. So I've been on trading floors and supported traders and work with them, and this is how they do it, right? And it's a system that I've developed over many years now, or have improved, I think, and built support services around, and that is the out-of-the-money butterfly. The primary principle behind it is that, well, of course, it's 0 DTE, so our objective is to try to take advantage, at least to some degree, the rapid premium decay of options on the index. And of course, being a 0 DTE day, and every day is a 0 DTE day with the SPX or the NDX, that day is the day that weekly options contract is decaying at the fastest rate in the shortest period of time. And so that presents an opportunity to potentially at least garner some of that. Now, it's impossible to get it all the time. It's just, it's not possible. And so instead, we want to try to come up with a way that is probabilistic, that will put us in the right place to give us the opportunity to grab the kind of profit that we're looking for or that may be presented to us. And it's not something that you can pull out every day. And that is unrealistic. People that think that way think that you can actually create an income from trading. And when I say an income, as if there is an equal opportunity every day to pull out the same amount of money. Now, I know that there are some strategies out there that attempt to do this, but they don't really do it, and they have some real big problems. One is they have a scalability problem. And most of those strategies are built on market neutral strategies or high probability strategies, either using an at-the-money butterfly or a very low delta Iron Condor or something similar to that. And those are not scalable because their distribution of returns are all wrong. In order to scale or to have any appreciable returns, you need massive amounts of capital. And so for that reason, it's not scalable. I mean, if you want to scale, you want to be able to scale up with a small amount of capital with very large return. And so that's why you need that asymmetry that an out-of-the-money butterfly supplies. And quite frankly, this is really what most pro traders that I've ever seen trade. I mean, this is it. This is why they do it. Now, how they set up the trade is kind of interesting, marginally interesting, because they do it in such a way that doesn't require them to put a lot of thought into it. And they don't want to put a lot of thought into it. They just want to put these trades on. And sometimes one of these traders will put on a number of these, one right after the other, and trying it on, and then manage each one of those coming in. But generally what we do is we just do one trade, one a day, and then try to manage that. And it's got a lot of flexibility into it. In other words, you can trade it with a very small account, you can trade it with a medium-sized account, you can trade it with a very large account, you can trade it with extreme volatility or very little volatility. Of course, each of those market types are going to give you a different result, and you have to adjust your trade to accommodate those market types. Now, the way most pro traders put one of these trades on is without regard to where they're putting it on. When you're on the trading floor, of course you're going to do your research and figure out what type of energies are coming into the market, market reports, etc. Plus, when you're on the trading floor, you're also looking at the activity that's there, and so you can get a good feel for what's happening, what price action looks like, and you've got all the big boards there, and you can see everything that's happening. But it's not enough to give you any real advantage. And so the idea then is to put the trade on in a really agnostic way. And so what that means is that without regard to what the underlying market structure or the energies that are coming in, and then work on actually how you're going to manage the trade after it's been put on. Now, you also know that there's a certain setup that you want to do that's going to help you put the trade on, and they'll also give you a kind of a sweet spot for collecting premium or for being successful in general. And that trade will adjust depending on what, like I said, what the underlying market structure is. And what do I mean by that? Well, I mean that when you have a very high volatility regime, like right now, we're in a super low volatility regime. The VIX is, well, where is the VIX? The VIX is way, way, way down there. Maybe we can get a picture of what that looks like. No, that's not it. Right there. That's not it either. There it is. All right. Now you can see how, now this goes all the way back to the pandemic, and you can see there's the crash that we had there. And I have these two green lines that I consider the Goldilocks zone, and that's where maybe 95% of all trading occurs. And generally, I split it up when we're in that area. That's kind of normalcy for most markets. And I always want to know, are we in the top third, bottom third, or are we right in the heart of the Goldilocks zone? Now, this area that I've defined is also well known to other types of traders that were on the floor that are using similar strategy, or not the similar strategy to this, but are using strategies that are very common on the trade floor, like the orb or the open range breakout. And they won't trade anything unless it's in the top 2/3 of the market. Once you start getting down to the lower third or below a VIX of 17, the orb strategy is basically useless. But let's get back to the out of the money butterfly. Now, the butterfly is an interesting strategy. It's largely considered Vega negative, and so we need to understand exactly what that means. Oops, let's go here. Now, Vega negative means that if you had a butterfly, it benefits from falling volatility. And what I mean by benefit is that premium tends to decay faster or decay earlier, at least start decaying earlier. Now, there's nothing that can be done in terms of volatility or Vega that will affect premium that much once you start getting into the waning hours of the market, when you're in the last 2 hours of the market. There's virtually nothing that volatility can do to affect how fast or how slow premium is decaying. I mean, once that happens, it's like you're in the vortex, you're on over the event horizon of a black hole, and it's going down. There's absolutely, time is the number one arbiter of how premium decays once you get to that part of the day. But in the beginning part of the day, there are a lot of things that can affect a butterfly in terms of volatility. When you have very, very high volatility, at least from a butterfly point of view, that will suppress the premium decay. It'll suppress it. Now, what it's really doing is it's loading up premium on the individual contracts, but it's giving you a greater opportunity to get into that fly if it's out of the money with a better price and more potential decay from then until the end of the day. Conversely, if volatility is very low, then that premium decay is kind of preloaded. It happens faster, and so the volatility curve, the P&L curve inside of that same butterfly will already look like it's been decayed. As a matter of fact, in the morning, you can take a 20 wide butterfly on a day like today where volatility is very low, and it will look like it's already halfway decayed. Now, if you go, let's say, I don't know, back in February or March of this year when volatility was much higher, that same butterfly would have an absolutely flat P&L curve. It'll be flat, and there'll be plenty of room for it to decay over the day. So that's really the difference between one volatility regime over another. So those are the type of things that you need to understand, that when you're getting into a fly, an out-of-the-money fly, and how wide you want to make it, how far out of the money you want it, etc. And what's the underlying market structure look like, or market type? Are we in a high volatility regime or not? So also what it's saying is, if you understand how butterflies work, and if you were to look at butterflies during a high volatility regime, you would find that the narrower the butterfly, the later in the day that it starts filling up with premium. All right? That's in a high volatility regime. In the current regime with extremely low volatility, even the narrow flies have already been preloaded. So they don't have a long ways to go to decay or to give more potential. Now, then they act more like a more directional trade. So if you're out of the money, then you're really counting on that premium curve having some lift to it. Now, there is some premium decay, obviously. It's just that it's already preloaded. So it's a very different game in low volatility. So what that really means is that in low volatility environments, you want to have narrower flies generally, rather than much wider flies. Normally, when we're in a regular environment, I don't consider this very regular. It depends on how long it lasts before it becomes regular to everybody. But when volatility is in a normal zone between 20 and 30 or so, I'm more apt to put on a much wider fly, because I think that I'll be able to get a good price on it. I'll be able to get good action during that day, a nice range in price, and the opportunity to make a lot of money as premium is decaying. And that profit curve, starting very low, has a long way to rise until it gets into the butterfly. I mean, if it's already up here, it doesn't have very far to rise. It just goes like that. If it's down here, then it's going to rise up like that. So that's really the difference. So those are some of the extraneous issues surrounding a butterfly when you're trading 0 DTE. Now, as I said, we're following along with what a lot of these pro traders, floor traders would do. And they have something that they call the 10% debit rule. And the 10% debit rule is really a sort of an accounting ease on how they're going to price their fly and put it on. And it just makes it easy for them. The idea is that they want to pay 10% of the width of the fly. Now, if you were to take 10% of the width of a fly, for instance, if you had a 30 wide fly, then the debit would be $3. That's $3 is 10% of 30. If it was 20 wide, then it would be $2. And so that's kind of an accounting thing that they do, makes it easy to put on the fly. But they had another benefit to it. They found that the risk to reward ratio that would create would be 1 to 9. And that seems to be a sweet spot in terms of your overall return when managing these trades. So it doesn't really come down to what most people think. They want to know, well, don't I have to figure out how far away it is from at the money? I mean, do I look at probability of touch? Do I look at expected move? What do I look at? Do I look at delta? And the answer is no. You don't look at any of those things. Those are not the determining factors. The determining factors are the width and your risk to reward, your use of capital, the efficiency of the capital, that 1 to 9 risk to reward, or better. Now, what I've found is that 1 to 9, while it's easy for the floor trader to put on, and they are more than happy to deal with a strategy in that realm, they don't have the advantage of being, sitting at a desk and in front of a computer with, and then examining all these different possibilities. They do that because it's convenience and they can do it. But you'll find that putting on cheaper flies and going for a higher risk to reward, at least in my experience, tends to have a slightly better return overall. And I can show this by looking at a large number of trades and looking at them in all different ratios that we put on. So I've looked at them from 1 to 3 all the way up to 1 to 20 with real trades, real money, real management, etc. And while there's a sweet spot somewhere between 8 and 11, it seems to kind of peak somewhere between 9 and 11, I'd say, or 9 and 10. And there are also very good opportunities for much higher risk to rewards, as high as 1 to 15 or 1 to 18. So where in some cases, if you're trying to put on a debit on your fly for only 10%, it might even be worth putting it on for 5%. Those tend to be best on days where you expect a lot of movement, obviously. Maybe in this environment, those aren't as good. So those are the types of considerations that you want to put on yourself when you're adding these flies. And you don't have to take a whole lot of time to figure out, where am I? How big is it going to be? How far away from at the money? How many strikes out? People are constantly clamoring around that, and they think that, man, if I can just get it closer, I'll have a better chance for profiting. That may be true, but your overall profit's going to be less, and your risk that you take on is going to be much more. So when you're trying to move a fly closer and closer to the money, you're sacrificing something. You're sacrificing that risk to reward. You're minimizing or diminishing the total amount of profit that you can go for, and you're increasing your risk. So now you're creating a completely different ballgame. So, like I said, there's a sweet spot in terms of the balance between the risk that you take and the amount of reward that's available to you. And the market, for the most part, or for all parts, is going to be pricing your strategy appropriately. So when you put on a 1 to 9, it is going to price and place your trade in the appropriate spot based on what the market perceives as the expected move, right? You might say, well, shouldn't I be doing expected move? Well, expected move is really calculated on statistical averages. It's not being calculated on what the market is pricing things at. So one comes before the other. The expected move is a calculation that's a derivative of what the pricing of options are, not the other way around. Pricings of options aren't a derivative of expected move. So by going for expected move, you're basically putting the cart before the horse. It's that's a horrible analogy, but you're using something that is a derivative of the actual data that you should be looking at, or the reliability. You should be looking at what the market is pricing it at. That is going to give you the true idea of where that option should be placed, where that strategy should be placed. And that's something that a lot of people have a hard time processing. I don't need a statistical calculation that is pegged to a standard deviation to tell me where I should place my trade. I want the market to tell me where the trade should be placed. Right? Those are two very different things. I know it's hard to, to process. So that makes actually putting on the trade a lot easier. Yeah, if you like this video, by the way, please give it a thumbs up. This is content that you're not going to hear anywhere else. This is content that is exactly what pros are doing on trading floors, what they've been doing for decades, and what works, right? So it makes putting the trade on relatively simple. You don't care about where it actually goes. All you care about is the cost and whether the cost is the right ratio. And you don't have to be exacting either. And you can get into the trade. Wherever you're going to get into the trade, it's going to be appropriately priced for what you pay for it at that time. Now, of course, it would be better if you could get, if you have the same opportunity and you can get a slightly better price for the same width. But if you get a better price, that means that everything's going to be changing a little bit, and it might not be as good of an opportunity. You just don't know. So you try to hit a sweet spot. You try to do something that's consistent and do it over and over and over. And it doesn't matter if you get 10% or 8% or 6% or whatever that is, or if you do a 20 wide or 25 wide or a 30 wide, or if you go to the NDX and you do a 40 wide or a 60 wide. None of that really matters. I mean, it might matter, in terms of choosing SPX over NDX because maybe the NDX is experiencing more volatility, as an example. But overall, it doesn't matter. These should be all kind of really dependent upon what your total capacity for risk is and what's your maximum position size. That's what you need to know. You want to try to put on a risk to reward, a certain width that will support your position size, and also your capacity and tolerance for risk. So that's what it really comes down to. Yeah. So Charles says it's a perfect day for an iron fly. I just saw that, and I was saying, yeah, only if we knew that ahead of time. But you don't. You don't know that. Now, you could put on an iron fly every day, and this past week, there would have been a couple of good days, but other days that would have been horrible, absolutely horrendous this past week. So, sure, I wish I knew what was going to be the future outcome of every day, and then I would choose the appropriate strategy that would maximize my profits every time. Unfortunately, that's not reality. So you stick with a certain strategy and you practice that, and you take the good and the bad. You try to preserve your capital and keep yourself in play for those larger profitable days. You also try to grab all small profits. Don't let any small profit go away. Allowing a small profit to fizzle away creates a huge turnaround in what could have been holding the line or preserving that capital. I mean, that's the number one goal there. Yeah. And of course, Donna was thinking the same thing. I think the same thing too. I think, man, if I had only put it there today, I would have been so much better off. Or there, I would have been way better off. But hindsight's 20/20, and none of us have that. None of us have a crystal ball. And if you play that strategy, as I said in the beginning, those are seemingly attractive to most retail traders, but they're not so attractive to a pro because they know that the capital efficiency isn't there. The asymmetry isn't there. Over the long term, they're looking for return and scalability. You won't get the scalability with that strategy if you employ it every day. You simply can't. You can't scale a strategy like that to anything big. So that's really the straight scoop. That's what out of the money butterflies are all about. They're really patterning after some of what most floor traders were doing with options and flies, and using some of the basic tenets, but then taking it to the next level. And that's what we do in this service. If you're interested in that, go down below, click the link for the 4-week trial, and you'll find out how you can become consistently profitable, independent, and trade at a pro level. Trading with us is like joining a prop trading firm where you're going to get a program and instruction on, and a study program around learning how to trade like a floor trader. You'll also be assigned a coach, a mentor, and you'll be sitting next to some of the most experienced traders around with a great trade room. It's the type of environment where you can learn to become consistently profitable. So there you go. All right, that's about all I have to say. I want to thank you all. Peace to you all. I have to put this one up so you can see the aura ring. Very important. Aura ring. Take care. See you on Wednesday. Every Monday, Wednesday, and Friday, we have this show. Thank you for those people. Oh, tell them about the dietary restrictions. All right. So, yeah, let me just say that. And I'm not going to just talk about the dietary restrictions. I'm going to say that, when you're trading, everything's about process. And being in the best shape, both physically and mentally, that you possibly can be. And so what Steve is talking about is that we take it very seriously here. It's not only getting your mind right, but it's also getting your body right. Getting the right sleep, having the right diet, being in the best mental condition that you possibly can be. All of those things you will learn here. And we'll talk about that, the dietary stuff, in an upcoming interview that I'm going to have. Should I say who it's going to be with? No, but it is somebody that I have interviewed before, and he is with another trading service. But I think you'll find it very interesting when we start talking about performance from a dietary and health perspective. All right. So, yes, peace to you all. See you all later. See you Wednesday. Take care. Need the music. No, carnivore.